All right, let's just jump right into it. This is a question pretty much every investor has to ask themselves at some point. You get a bonus, an inheritance, maybe you've just been saving up a big chunk of cash, and there you are, staring at it, thinking, what is the smartest way to get this money into the market?
And that's the big dilemma, right? Do you just cannonball into the pool all at once, or do you kind of dip your toes in, inch by inch? Now, the answer might seem obvious to a lot of people, but as we're about to find out, the data, well, it tells a very different and honestly, a pretty surprising story.
So first things first, let's get our terms straight. On one side, you've got lump sum investing, or LSI. This is the all-at-once plan. You have the money, you invest it. Boom, done. On the other side is dollar cost averaging, or DCA. And this is the gradual approach, taking that same pile of money and investing it in smaller, regular chunks over a set amount of time, like, say, a year.
Now, for decades, the conventional wisdom has basically screamed from the rooftops that dollar cost averaging is the way to go. And it sounds super smart, doesn't it? I mean, as the economist Burton Malkiel put it, you avoid that nightmare scenario of putting all your money in right before a massive crash. You spread it out, you buy more when prices are low, less when they're high. It's always sold as the safe, prudent choice.
But what happens when we take that comforting advice, that dogma, and stack it up against decades of cold, hard data? This is where the whole story really takes a turn. We're going to put this supposedly safer strategy to the test against what the market has actually done.
The entire idea behind DCA is to protect you if the market goes down. But here's the thing. What if it doesn't? What if the market does what it's historically done most of the time, which is go up? Let's see what the numbers have to say about that.
And here it is, our first big number. Looking at major markets all around the world, throwing your money in all at once has beaten the gradual DCA approach about 2/3 of the time. Think about that. That's not a coin flip. That is a huge, consistent edge.
And it gets even more dramatic if we zoom in on the US market. An analysis of the S&P 500 over the past 40 years found that the lump sum strategy won out a staggering 82% of the time, compared to putting the money in monthly over a year. 82%.
What's so wild about this is that it isn't some new trend. Just look at these time periods. It doesn't matter if you're looking at data from the 1920s or the 1970s, lump sum investing wins consistently, almost 2/3 of the time. This is a really durable, long-term pattern.
And this chart just makes the financial hit crystal clear. Look at this. In the post-war era, the lump sum strategy returned, on average, over 13% a year. The 12 months DCA plan, under 10%. That gap, that's almost 4 percentage points every single year. That is a massive difference when you let it compound over time.
Okay, so the data is pretty obvious about what happens. But the real question, the one we need to answer, is why? Why on earth does the strategy that feels riskier, going all in at once, end up winning so consistently?
And the answer boils down to one of the most basic ideas in all of finance: opportunity cost. It's the idea that every decision to not do something with your money has a price tag. And in this case, the price of waiting is really, really high. Let me break it down. The stock market, it's not a 50-50 coin flip. Over the long haul, it has a strong upward tilt. In fact, in any given year, the US market has gone up about 70 to 75% of the time. So when you choose to dollar cost average, you are consciously choosing to keep a big piece of your money sitting in cash on the sidelines. You're effectively betting that this is one of those rare times the market will go down. And most of the time, that's just a losing bet. You miss out on all the gains that uninvested cash could have been making for you.
And it just makes sense, right? The longer you stretch out that DCA plan, say you decide to do it over 2 years instead of 1, the more you're going to pay in that opportunity cost. You're keeping your money out of the game for even longer, which just makes that potential performance gap even wider.
Okay, so this leads us to this really fascinating paradox. If the math is so overwhelmingly clear, why in the world is dollar cost averaging so popular? Why is it recommended all the time? Why do so many smart people pick the strategy that's statistically likely to make them less money?
Well, the answer has almost nothing to do with a calculator and everything to do with our brains. See, we're not robots running on pure logic. We are emotional creatures, and that little voice in our head screaming about the fear of loss is often way louder than the one whispering about the prospect of gain.
There's actually a name for this in behavioral finance. It's called regret aversion. It is that horrible gut punch feeling of what if? What if I invest all $50,000 today and the market tanks tomorrow? The potential pain of that regret is so intense that we'll actually choose a worse strategy just to avoid feeling it.
And this is brilliant. Some research from Vanguard shows that DCA really does act like an emotional cushion.
It works. Look at this. Historically, people who use DCA saw their portfolios go down less often, and when they did go down, the average loss was way smaller. DCA basically smooths out the ride for you, even if it means you end up at a slightly lower destination.
A researcher named Meir Statman found that a few common mental mistakes push us towards DCA. Our fear of losing money makes us pessimistic. We tend to frame the market like it's a poker game. If I win, someone else has to lose, when in reality, it's a positive-sum game where lots of people can win together. And then there's confirmation bias. We have a crystal-clear memory of the 2008 crash, a time when DCA would have felt amazing, but we conveniently forget all those other years, the majority of years, where it just made us miss out on gains. So let's wrap all this up. Let's get to a final verdict. After looking at the math on one side and the psychology on the other, what is dollar-cost averaging, really? Is it a genuine investment strategy, or is it something else?
I saw one analyst put it this way, and I think it is just the perfect summary of this whole thing. DCA isn't really a financial strategy built to maximize your money. It's a behavioral coping mechanism built to minimize your anxiety.
And that's the real trade-off, right here. The choice isn't between a good strategy and a bad one. It's about what you're optimizing for. Lump sum investing, based on all the history, is for maximizing your potential wealth. Dollar-cost averaging is for managing your emotions and making sure you don't feel regret. You're literally trading potential returns for peace of mind.
And this is so important to understand. The real danger here isn't what you think it is. The biggest risk isn't investing a lump sum at the worst possible moment. No way. The absolute biggest risk is that the fear of making a mistake paralyzes you, and you do nothing. You just leave that cash on the sidelines for years, earning zero.
So maybe the whole time, we've been asking the wrong question. It's not about which method is better on a spreadsheet. It's about you. Which of these strategies are you actually going to be able to stick with through the good times and the bad, without freaking out?
Because really, at the end of the day, the best investment plan in the world is the one that you can actually follow without panicking and selling at the worst time. If the thought of putting all your money in at once is going to make you lose sleep for a month, then you know what? The suboptimal choice of DCA is probably the optimal choice for you. The key is to know yourself, know your own tolerance for risk and regret, and then just pick your path and go.